Hello and welcome to the earnings preview with ET Nav. It is the start of yet another earnings season, and while IndusInd Bank has kick-started the earnings season in fine fettle, it promises to be a very important week and a very important quarter as well. Primarily because quarter 4 was one wherein people didn't anticipate too much and then we got a surprise. This quarter is where people anticipate that maybe, just maybe, there could be a bit of an earnings momentum coming back. And if the street is disappointed, that could be a big dampener. I'm Niraj Shah. Let's talk about what the consensus is working with before we get into specific names and specific brokerages. Let's just give you a sense of what the consensus believes will happen. This is of course BofA ML, we'll get you Kotak, we'll get you CLSA and the others. But the consensus Q1 estimates believes that Q1 earnings will decline by about 5 to 6%. That is essentially the consensus view. The PAT improvement will be seen for the cement, consumer products and the IT sectors, and there could be a PAT decline in banks and oil and gas. So that's essentially the consensus view that has come in on the key earnings. Now, within that, agri-chemicals could report a good quarter and good commentary. Engineering and construction companies could actually report a good top line and a bottom line growth, and pharma could actually witness a bit of a turnaround. That is what the consensus views are. Let's get in Avan Dubaj from our research desk to talk about what is it that Kotak Institutional Equities is penciling in when it comes to the quarter 1 revenues. Avan.
Well, here's what Kotak Institutional Equities is expecting from the earnings this time around. By and large, they say that the Q1 net profit could decline by about 6.9% for companies overall. In terms of the net income of BSE 30 companies, they expect that to decline by just about 2% on year. Let's run you through the sectors where they see promise and where they expect a disappointment. Banking and energy sectors here is where they're expecting to see an earnings decline, whereas a profit improvement is seen for cement, consumer products, pharma, as well as the IT space. In terms of the auto sector specifically, they're expecting reporting a drop of about 9% year on year on the net profits. Banks are expected to be a big disappointment according to Kotak Institutional. They see a 40% decline in the earnings, and that's largely attributed to the weak revenue growth. Upstream oil companies, well, the profitability here is likely to improve largely on account of the way crude oil prices have been trending. Capital goods, by and large, according to Kotak, is likely to remain very lackluster, largely on account of the very sluggish order inflow. When it comes to metals, they believe that the domestic steel companies are likely to report a sharp improvement in the earnings. For the pharma sector, it's domestic formulations growth, and that's likely to be mixed among most of the pharma companies. Real estate is likely to see a disappointment in earnings this time around, largely due to the fact that liquidity has remained weak due to lower sales. And finally, for power PSUs, Kotak Institutional Equities says that they could post strong earnings in the quarter.
Okay, that's of course, Avan, thanks a lot for that. So that's of course what Kotak Institutional Equities believes could happen in the quarter. But as I was saying, I mean, if you just look at what the consensus sector watch is for revenue growth and PAT growth for the different sectors, this is of course what the street believes. The overall earnings will decline by about 5 to 6%, as I was saying. There's PAT improvement seen for cement, consumer products and IT, and there is a PAT decline seen in banks, largely led by PSU banks, of course, and oil and gas. And within specific spaces, you know, I'm just trying to go down the line a bit and look at mid caps. There is a good quarter expected for the agri-chemicals, and which will be backed by strong commentary as well. So the PI industries of the world could actually do well and give good quarter. Engineering and construction could report a good strong growth as well. So you'll have the Sadbhav Engineerings, maybe L&T and all eyes out on the kind of order book numbers that they give out. I think this will be a very, very important quarter for them because the street expects them to deliver, and they better deliver. It could be a bit of a turnaround quarter for pharma, led predominantly by Sun and Lupin, but a lot of mid caps as well. And I think all eyes will be on the commentary that the pharma sector has to give, quite frankly. So it will be very, very important from that perspective. As I was saying, PSU banks could report on the quarter of a tepid performance, and then watch out for individual instances. I mean, you know, Motherson Sumi, Bharat Forge, etc., could well have issues. These are large corporate names in the auto component space, globally exposed, and there could be a bit of an issue there. That is, of course, what individual sectors will do. But a very special guest, needs no introduction, Manish Sonthalia. He joins us right now to talk about his thoughts on the expectations from this earnings. Manish, so good of you to join us. Thanks for joining in. The street seems to be believing that there will be a bit of a recovery, and this is quite unlike how we approach the quarter 4 earnings season. Are you as well in the camp which believes that there could be a recovery? And if that doesn't come, will that be a big disappointment?
No, so in aggregate, the earnings are not going to grow because obviously we are going to see negative contribution on a YOY basis coming from metals, oil and gas, because they have seen a significant decline. Like oil prices are down some 35% on a GRM basis, the oil marketing companies. So that will have an impact on your downstream companies. Or if you were to look into, let's say, the metal companies on a YOY basis is down something like 25%. So obviously if you were to exclude these elements as well as the impact of public sector banks, which could see something like a 40% degrowth in profits, I think numbers should be probably be single digit, 6-7% sort of a net PAT growth on an aggregate basis. So I believe that if there is no recovery even in this quarter from the sectors that we just talked about, it's going to be seen as a negative, and the markets would tend to sell off.
Where are you in terms of being anti-consensus, Manish? I'll just tell you what the consensus view is. The consensus view is that pharma will probably have a good revenue and PAT growth. FMCG could likely have a fairly decent bottom line growth, if not top line growth. And there is an expectation largely that BFSI, predominantly led by PSU banks, will do quite the opposite, which is come out with a disappointing bottom line performance. Are you in contrast with any of these assumptions?
No, I think public sector banks will disappoint. Obviously, provisioning will come off, but it's still going to be elevated. So private sector banks, net profit should be growing something like 15% in aggregate. Some will grow at 25%, some will grow at 10-12%. So in aggregate, they should be growing at 15%. Consumers, top line growth around 12%, bottom line growth 18-19%, because margin tailwinds are still coming in this quarter, and this is going to be more predominant in the consumer staples space as opposed to consumer discretionary. Consumer discretionary should also be on the positive side. Cement is going to be positive. So I don't think there is any major disconnect between what you are saying and what I'm saying.
Okay, let me scratch Manish Sonthalia's thoughts on banking and IT individually as well. But before that, since we are talking about banking and BFSI, let's get in Poonam Sani from our research desk to tell us what some of the individual companies are likely to do. Poonam.
Well, the bank earnings especially are going to be slightly better on a sequential basis, but again weak on a YOY basis. We should be seeing flat NII growth, but higher provisions are still likely to continue, but expect slightly lower fresh slippages in Q1. Having said that, in terms of the stock specifics, PNB is likely to report slightly better recoveries and upgrades, although they would be technical in nature. Axis Bank as well as ICICI Bank may report slight or sharp slowdown in terms of the earnings, but HDFC Bank, Federal Bank, City Union Bank, Karur Vyasa Bank are likely to report better numbers during the quarter, as well as in terms of Kotak Mahindra Bank, to watch out for the fee income growth because that had led to slight downgrades in the earlier quarters. In terms of the NBFC, still we should be seeing strong quarter continuing for the cyclical retail NBFCs. Margin expansion is still likely to continue, but we would also be seeing some amount of interest reversals also to support the earnings. Stock specifics, again, Shriram Transport, LIC Housing Finance are likely to report strong earnings. Bajaj Finance is likely to report again strong earnings because Q1 and Q3 are seasonally strong quarters. HDFC Limited is likely to in fact report at least a profit growth of nearly around 44%. We should be seeing strong profit growth coming in from Bajaj Finance, Cholamandalam, Mahindra Finance, Muthoot Finance as well as Bharat Financial. And in terms of the margin expansion, Bajaj Finance, Bharat Financial as well as Shriram City Union Finance should be reporting some amount of margin expansion.
Okay, Poonam, many thanks for that. Manish, lot of stocks discussed out there, the NBFC space, and you have quite a close coverage there. Do you think Bajaj Finance, for example, which for the first time in so many quarters, kind of referred that maybe at such a high base, the growth may not stay in the same vein as it has in the past. Do you think companies such as these might come under a bit of scrutiny because of the kind of valuations that they are trading at?
No, so they have always guided conservatively and they have always come out and beat their guidance. So that's going to be the norm even this time around. So I think numbers are going to be pretty strong. They are now moving into various other verticals of financing. So something like a rural, is a separate vertical for them altogether. They are now moving into funding or financing professionals like chartered accountants, doctors, and now even moving to medical treatments like hair transplantation, financing, and so on. So they have a whole lot of verticals where they are working on and cross-selling many products which are already under existence for them. So I really don't think that growth is going to be slower than 25% for them, and they are able to manage the NPAs pretty good. I don't think this company should be valued on a price to book basis. It should be valued on a price to earning basis. And price to earning basis, if you were to look at March 2016, it was trading at 32 times trading. So today, on March 31st, 2016, it was 32 times. March 31st, 2017, it would again be 30 times trading. So between now and March 2017, there's still something like a 15% upside according to me, on a price to earning basis.
Okay, I get your point, Manish. So that's with regards to these. What about the PSU banking space? I mean, we're just looking at disappointments out there galore. Could there be a positive surprise by any of these? I mean, BOB kind of in quarter 3 sprung up a surprise and then only failed to deliver, so to say, as per market expectations. So that was a bit of a negative surprise. Could there be a positive surprise somewhere?
Looks very unlikely, if there was anything to be seen as a positive surprise, we would have heard about it all along the quarter, the April, May, June quarter, but nothing positive on the recovery front per se, so to speak. Only silver lining is that the provisioning is going to taper off. It's still going to remain at fairly elevated levels. So I don't expect too many positive surprises on the PSU banking front. In fact, there could be some negative surprises which could spook the market on the private sector bank space, corporate side, those who are heavy on the corporate book. But if they report okay set of numbers, then markets would still hold out. But if there are some negative surprises coming from the private sector bank, market would definitely sell off in these names. But PSU banks, I really don't expect too many positive surprises this quarter.
Okay, so that's the largest of the sectors, so to say, the heavyweight space, 27, 28, 29% weightage that it has. The other large sector, and something that could be a bit uncertain this time around, primarily because of all the global headwinds as well as issues coming up in terms of visas and a few other things, is the IT space. As important is this quarter is also the kind of commentary that they give for the year ahead. Is there uncertainty, or can they actually navigate through this well? Before I get in Manish's view, let's get in Sunita Nagpal from our research desk to talk about what is to be expected from each of these individual companies. Sunita.
This will be a mixed quarter for IT sector, largely because Q1 is seasonally a strong quarter. So we are expecting financial growth to be strong, roughly about 2.5% to 5% sequential growth expected in dollar terms from tier 1 companies. But at the same time, we are expecting the commentary to be weak this quarter, largely because of the uncertainty related to Brexit and the European region. That's something that will cloud the outlook going forward. As far as tier 1 companies, TCS and Infosys are expected, they're expected to show a revenue growth of roughly about 4.5% and 4% this quarter. Margins will come under pressure for the whole sector, largely because this is the time when the visa costs kick in, and also some of them will be giving wage hikes, so their cost will increase, putting pressure on the margins. Deal wins expected to be strong, but the commentary related to deal wins going forward because of the exposure to European region is something that we need to watch out for. In case of HCL Tech, we are expecting strong revenue growth, largely helped by Volvo deal that they've seen. In case of Wipro, because this is a seasonally a weak quarter for them, we are expecting a flattish growth. TCS and HCL Tech should report strong numbers. Infosys, we need to keep an eye on, largely because they are likely to cut their dollar revenue growth guidance for FY17 while maintaining the constant currency guidance.
Great. Sunita, thanks a lot for getting us that update. And Manish, I think it's arguably one of the most difficult spaces to navigate right now, because as important are the Q1 earnings, also the commentary and the confidence that the management has. And Andrew Holland, of course, joins in this discussion too. But Manish, this question is for you. What do you anticipate IT to do? Can the HCL Techs and the Tech Mahindras, which have disappointed thus far, spring any surprises?
Not really. I think IT is going to underperform for the near term. I think volume growth is going to be pretty good at around 4%. And this is across the tier 1 IT players, the large ones. But we are going to see cross-currency headwinds, which will take a toll on the effective realization as well as the margins. And that's not going to go down well, with the numbers per se. It's going to be an okay set of numbers for the IT as a space, but I think the uncertainty surrounding the Brexit and the commentary surrounding BFSI as a space would be keenly watched out for. Other verticals, something like a telecom would directly impact Tech Mahindra per se. HCL Tech, Volvo deal would be good for them, and they would report some positive numbers this quarter. But on an overall basis, I don't think it's going to be a very strong quarter for the IT space. I think commentary would be much more important than what the numbers would be like. But Brexit is clearly going to be an overhang on this space.
Surely. Manish, before we let you go, what is the dark horse? Where do you see the street not penciling in any kind of recovery, and you personally believe that there could be a show of strength, if not this quarter, then in the near term?
No, so I think if the government spending is coming about, then obviously cement as a space, particularly in the mid-cap cement space, where there's some valuation comfort. Large cap names are obscenely priced in valuation, but here we could be surprised as far as the volume growth on the cement space could be concerned. So that may be, of course they have all run up, but maybe there's still some upside on the upside, still some upside in this space.
Okay, Manish, understand we have to let you go, but thank you so much. Really appreciate you taking the time out and joining us and giving us your sense of the earnings expectations. Take a break on that note. Andrew Holland, of course, has just joined in. We'll touch base with him and his thoughts on the other side of this break. Stay tuned. Right, back with Earnings with ET now, the preview show, and joined by yet another special guest, Andrew Holland of Ambit Capital. And Andrew, thanks so much for joining in. Your thoughts on the Q1 earnings going forward?
Global continues as it is, and the earnings season, even if it's lukewarm, we'll probably see how the pattern of the monsoon goes, and if that's still okay, then obviously we'll still have hopes that the second half of the year, as the economy picks up, earnings will do so too. So we're still thinking earnings at the moment of anywhere between 5 to 10%. If the monsoons are good, then that could be more between 10 and 15. But we're not seeing a blockbuster kind of rise in earnings at the moment. Companies we speak to, it's still very patchy across different industries. So it'll be, if markets turn down and you have a lukewarm earnings season, then obviously markets are probably not pricing that factor that in at the moment. So you would see markets correct from here.
Okay, well, Andrew obviously doesn't give out earnings estimate reports. I think other brokerages have. So we spoke to you about how Kotak, or what Kotak view is. Now let's get in Mobina to talk about the CLSA view. Mobina.
Well, it's another quarter of a decline, but this time around the decline is marginal. That's what CLSA is expecting, a decline of 1% year on year in quarter one. Now, it's a substantial improvement from the 22% decline that we saw, which was, of course, primarily led by financials that we saw in fourth quarter. What's really going to lead to this is the fact that there is going to be margin improvement. In fact, CLSA says that the peak is not far from that one. But let's get in some sector-specific ideas then. They believe that cement will have that 15% growth because of low base, and that's something that's really going to drive the overall earnings. Metals, media, power, those two will be able to put in some good earnings of 15%. Autos, consumers, pharma as well, double-digit gains seen over there. IT sector, as usual, will a tad bit be sluggish because of the single-digit growth that is expected. But on the flip side, what's really going to lag the earnings is the likes of PSU, oil and gas, property. Those guys are going to see some big declines coming in, and of course followed by telecom as well as other banks. Strong numbers, well, metal companies will report better numbers on the back of strong margins. In terms of individual pharma stocks, it's Sun Pharma and Lupin that are expected to report strong numbers on the back of low base as well as new launches, and ACC Ambuja as well. A 40% earnings growth is expected over there. But in terms of weak numbers, it's Dr. Reddy's really that tops the charts over there, expected to have a weak Q1 on pricing pressure as well as lack of options. Reliance Communication on back of the weak subscriber base, and Bharat Forge that could see a 20% plus profit decline, and that's something that could weaken the stock further. So let's get in a roundup of all of the sectors that's really going to see what kind of revenue growth and what kind of profit after tax growth. Really, pharma leading the list over there, 12.5% top line and 35% bottom line growth seen over there, followed by autos, FMCG, both of them seeing a good 10% top line growth. So it's mostly the consumer stocks that's going to lead the gains over there. But the banking sector, while top line will grow by 9.5%, the earnings are going to be a laggard, down for almost 14%. PSUs, we know the story, of course, oil and gas PSUs on the back of the decrease in the oil and gas prices is going to be down as well. But telecom, 37% decline in earnings growth. So that's going to be lagging the sector indices in across the Indian corporates.
Okay, thanks a lot for that, Mubina. And Andrew, if you heard Mubina, it seemed all about mid caps this earnings season. Is that your sense too? What will perform, mid caps or large caps?
If I go back to thinking about India, if you're even looking from a global context, if India is growing, it's a domestic growth story. It's not an export-led growth story. So that's the reason you would see that mid cap should actually be doing better in terms of earnings. But we'll have to see if that really plays out on the fact that in the large caps there hasn't really been many sectors which have taken a shine for investors, so therefore they've been looking more individually at the mid-cap sector for the growth stories there, which are plenty, and I'm sure you've highlighted many of them today. So I say it's more broad brush approach in terms that mid-caps are more domestic oriented, and therefore they should be getting better earnings growth as the economy starts to accelerate.
Okay, Andrew, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective. With that, it's a wrap on this leg of Earnings with ET Now, the preview show. All fingers crossed for what is believed to be a flat earnings season, but people are hopeful that there will be individual surprises. Thanks so much for watching.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.